we're going to do a little bit of illustration today, family. We're going to break down exactly how shorting works, right? Because again, knowing how to, buy a stock is very easy, but shorting is not as easy to understand, right? So here we're going to give an instance, right? So let's bring people up. Let's see what we've got today. So let's say we've got Neil. We've got this Neil. I mean, this is Neil. And then let's have Celia. I was gonna write Celia in here. Hold on. Me and Celia, right? And let's say they let's do this. Let's say, for instance, this here is a stock. Sing Saying Taxes is a stock, right? And then we have the market. Let's say we have a market, right? We're going to say that this represents the stock market, right? The market value for this stock, let's say this stock is, Acme Corporation, right? We're going to say, let's say the market rate for, this stock here is $100, right? Put my illustration skills on. So this is the going rate, right? It's $100 for this Acme stock, right? Very simple. We're going to say that Celia here owns this Acme stock, right? If Neil wants to buy this stock from Celia, he has to pay $100 for the stock because this is the going rate, right? So let me bring up a wallet. And let me bring up another wallet for Celia as well. Let's utilize this one for Celia. All right. So very simple, right? If the going rate for this stock is $100, we're going to say that Neil has $100 in his wallet. Let's bring this bigger. Pretty simple, right? Neil takes his $100, gives it to Celia, and in turn, Neil gets his $100 worth of stock, right? Very simple. This is what you call buying, right? Or they call this in trading terms going long. So long is another word for buying, right? But how do you short a stock, right? How do you go short? How do you make money when the stock market goes down? What is shorting, right? So we're going to do it this way. Let's say, for instance, well, hold on. Let me finish that off, right? So if now Neil has bought this stock for $100 and the market goes up by $100, so now the market value for this stock is now $200. Neil now has in his wallet, let me draw this. he has the total value of a $200 stock now, right? Stock is now worth $200 because he bought it for 100. He bought it for 100, and now it's gone up by 100. So now he has, the value of $200 in his wallet. So, if he sells this stock now, he ends up with $200, right? So he made money by the stock market going up. It went up by $100, which is 100%, and that's how he made, $100 on top of that, right? Very simple. When we're going up. So how do you short now? How do you make money from the market going down? All right, we're going to illustrate. Let's go back to our market. Here we go. So let's say the market is $100, right? Celia owns this stock, which is $100. Now, Neil believes that by next week, that this stock is going to go down to $50, right? Or he believes that the price is going to go down, right? So what Neil would do, Neil will go to Celia and say, hey, Celia, can I borrow your stock and give it back to you at a later date? Celia says, sure, of course you can borrow my stock, right? So you can borrow it as long as you pay me like interest or like a rental fee for that stock, okay? So they make an agreement. So let's say, for instance, in this example, Neil will pay Celia $1 a day for every day that he holds onto this stock, right? So they make an agreement. Now, Neil takes this stock and instantly sells it to the market. The going price for this stock is $100. So Neil now has $100. $100, right? Lo and behold, 7 days later, the market price falls, just as Neil predicted. Neil predicted that the market will fall, and he was correct, right? The market fell to $50, right? So now the market has fallen to $50. Neil can then repurchase this stock for $50. So now Neil has the $50 stock. It cost him $50, and now he has the stock plus $50. At the end of these 7 days, he's now given back Celia the stock, and she is back in the position what she started with, right? So at the beginning of the transaction, Celia had the stock and Neil had nothing. And now at the end of it, Neil ended up with the stock and $50 and then returned Celia back to what she had. So Neil has now made $50 from the fact that the value of the stock fell, right? So this is how you make money from shorting, right? You make money by borrowing the stock and then selling the stock and then rebuying it at a cheaper price and then returning the stock at back to the owner of the stock, right? So this is how shorting was done. So this is a basic or simple explanation of shorting, right? Now, there is a more complicated, explanation to this, but we have to, in order to understand what short squeezing is, we have to make sure we understand the basic principle. Does everybody understand the basic principle of shorting? If not, let me know in the chat now before we go into the further short squeezing. Right, this is the basic understanding of shorting in order to understand a short squeeze and how a short squeeze work. Right, it was the fact that Neil predicted that the stock was going to go down, so he hedged his whole bet on it going down. So Celia said, so Celia makes money from the fees Neil will pay her. Correct. So this is the next level part of it, right? So understanding that if we, for instance, said that it was for 7 days and they agreed, $7 per day, out of this $50, Neil would have to minus the $7 that he was paying for each day that he rented it. So in reality, Celia, let me get this. Celia would have $7 in our example for loaning out the stock, right? It was $7 that she made because it was $1 a day in our example, right? So the benefit for Celia was that she managed to make $7 on a stock and she didn't have to sell the stock, right? It's almost like staking. If you're familiar with staking in crypto, it's the ability to utilize your asset and make money off the asset, right? And Neil was able to make money off of an asset that he didn't even own, really. He borrowed it, sold it, and then repurchased it at a later date, right? So this is how you end up with shorting, right? So this is our example of shorting. So is everybody clear on shorting before we go to short streak? So Celia asked the question, who sets the rate? It said, is a broker involved in a transaction between Neil and Celia? Yeah, so I'm just using, Celia as an example, but in this example, Celia would be the broker, right? Celia is actually the broker, which is setting the rates of these things and giving the stock. So, but just to simplify it, we're going to act like it's a person. But Celia, in this example, would actually be the broker, that you actually get the stock from, right? So that is correct. Yes, Celia would be the broker in this case, right? So, but again, we're just simplifying it here so we get the concept. The concept of making money when the market goes down or shorting is by borrowing the stock, selling it, and then repurchasing it at a later date and then giving it back. So again, so in our example, it wouldn't be $50. If we're going more in detail, it would actually be $43 Neil ends up with, right? So he started with nothing and ended up with, well, he started with $7, if you want to say that, and ended up with $43, right? So this is how you short. So what is a short squeeze? Well, a short squeeze comes from the fact that the setup of the play of a short squeeze is based on market conditions. When we're talking about a short squeeze, we're talking about the sentiment of a company looking like it's going to go down, and investors or major financial institutions perceiving that, okay, the value of this company is going to go down, so I'm going to speculate or put my money on the fact that the value of this company or whatever it is going to go down. So in our example, we'll use a company called AMC. So if we're talking about AMC, AMC is a theater chain, right? And they were looking like they were struggling in the first place, right? And at the time, again, we're talking about 2020. So we're looking at the area or the time of 2020. When 2020 came around, we had the whole lockdown scenario. Lockdown was something that meant that people were not able to go to cinemas. So it makes sense. If you're a company that is a cinema and relies on people being able to go out to you and be able to patronize your business, and everybody is not allowed to go outside of their house, then common sense would say that the value of this business is going to go down because people can't go to the cinema, right? So a lot of these investment funds, what they end up saying was, okay, we're going to definitely short this. Excuse me. Right. So it wasn't necessarily a bad idea or a bad play to short it. So all of these investment funds decided that they were going to short the company. So shorting works by, again, expecting the price of something to go down once you buy it. So let's say, for instance, this stock is AMC stock, and the current price, we're going back to our $100 scenario here. This trade is a little bit fiddly, so bear with me. So price of the stock is $100, and we're estimating that the stock will go down. Let me clear this. Let me clear this for now. We're estimating that the price of the stock is going to go down, right? So the stock is $100. Neil borrows the stock from Celia, and we got the same agreement, right? That we're going to pay you interest of $1 a day for the 7 days that we believe that it's going to take for this stock to go down, right? So we take our $100 stock, and as before, we sell this $100 stock to the market, and we end up with $100. Right. So now we're expecting that the market will go down. And as the market goes down, we can then repurchase the stock and return it back to Celia. However, instead of the market going down, the market actually goes up, right? The market, maybe. Oh, this trade is being a bit fiddly. Hold on. There you go. There you go. The market now, instead of going down, it goes up to $200, right? So now the market has gone up to $200 for this asset. We were actually wrong about the direction that it was going to go. Neil made a mistake and it's gone wrong. So the issue is for Neil now is he now cannot complete the trade, right? He cannot now return the AMC stock back to Celia simply because if he does so at this point, he would have lost $100, right? Because he has $100 and it cost him $100. So he would have to now pay $200. So he would be down $100, right? So this is the squeeze we're talking about. He's being squeezed in his position because it's going to cost him in order to exit the trade, right? So you can visualize this as one person, right? But when you're thinking about any kind of stock, there's never going to be one person buying a stock, right? There's always going to be multiple people buying stocks, right? So when you think about trading, trading is all about supply and demand, right? It's about the more supply there is of something, the less the least the price is. The more demand there is, the more increased the price is, right? It's like anything that is perceived to be rare is more expensive, right? So when we're looking at any sort of form of stocks, it's exactly the same thing, right? The more stocks that are available, the the more demand there is for something, the higher the price is, right? So if you think about, all of these people have now shorted this stock, and they've shorted it at a certain price, it's going to cost money in order to exit this trade. So if somebody now goes and pays 200 for the stock, it then increases the price, right? Because you're talking about demand for something. There are more people that want demand of this stock now, because of the position that everybody's in. There's so many people short in the stock that now the demand to get out of it is now increased, right? So now imagine a situation where you don't have, or you can't afford to exit your trade. That means you don't have the ability to exit the trade. Remember, all of this time, you've got to pay Celia her $1 a day fee in order to make sure you keep borrowing this stock from her, right? So you have a finite amount of money. So in this scenario here, this again is a simplified scenario. In this simplified scenario, after 100 days, Celia would have your $100, right? And then you would have actually run out of money in order to be able to hold on to the stock, right? Remember, this is a simplified explanation. Now, there are things like margin, which we're going to go into in a minute, but just in this example, we're going to say that, you have a limited amount of money, you have a finite amount of money in order to hold this trade open, right? So this is where the squeeze comes in. The squeeze comes in from the fact that the price of this stock in the market doesn't allow you to complete your transaction. It doesn't allow you to complete the other side of this transaction, which is allowing you to buy back the stock and return it back to Celia. That is the squeeze in the short squeeze, right? You're being squeezed because you can't close the transaction, yet you're still paying interest to the broker, who is Celia in this example, in order to keep the transaction open or keep the transaction going. Is that clear? Let me just check to see if everybody is okay. They're still following me. Okay. No questions so far. Okay, so we're having that. So now, if you think about it now, if again people start exiting the trade, again, that's increasing demand on the stock. And again, it's continuously increasing the value of the stock. So it becomes more and more expensive in order to exit the trade, right? So the more expensive it becomes to exit the trade, the more losses you're going to incur in order to exit the trade. So now you're faced with a dilemma, right? You're faced with a dilemma to either hold onto the stock and keep paying Celia her interest fee to for rental of this stock, or you cut your losses and pay out the nose or pay extra in order to just exit the trade and close it. Either way, you're losing money. You're losing money until, hopefully you hoping that the value of the stock comes back down to $100, and then you can exit for the price that you entered into, or ideally it falls below the $100, and then you can start making money on that interest on the investment. Sorry. Right. So that is what the squeeze is. The squeeze in the short squeeze, remember this, is the fact that the price keeps going up when you want to exit the trade. You cannot exit the trade because the price is higher than the price that you entered for. And not only that, it keeps going up. The more people try to exit the trade, it pushes the price even higher, right? So just to make sure everybody is clear about that. Okay, Neil Celia says makes sense. Okay, Neil, we're clear. Good. Okay, so now we understand what a short squeeze is. Let me decide which way to go from here now. So if we're clear that the value of the stock going up is the squeeze, and that is the thing that doesn't allow you to exit your trade, then if conversely, if the price or the value of the stock is going down, then that is more favorable for you because you can get out of your position and you are not being squeezed, right? If we're clear, we're not being squeezed if the price is going down. We're only being squeezed if the price is going up. There's a second component to this as well, right? Historically, there was a thing that happened with Volkswagen or VW. Similar story. When you have these setups of short squeezes, the short squeeze setup are generally always a similar sort of thing. We're talking about this short squeeze happened in 2008, and this is kind of one of the most historic short squeezes in history, right? Now, in 2008, the car industry was struggling anyway, right? It was on shaky ground, and we had companies like, I think it was like Ford, General Motors, Chrysler, and all of these companies were looking at losses. And when you're talking about the car industry is one of those industries that reflect the current state of society, right? So cars are looked at like a luxury item. When the economy is doing well, people buy new cars, and people have money to spend, and it's kind of like almost a lifestyle luxury item, right? When we're looking at the market or the economy going down, people generally don't buy cars and things like that. So it's something that really follows the state of the economy. What happened in '08, we all know that there was a financial crisis in 2008, correct? Right. So car companies were already on shaky ground at the time. In 2008, we know that we had the financial crisis. When we had the financial crisis in 2008, that again looked like an easy, surefire, shorting opportunity for VW, right? For Volkswagen. Because, at that time as well, as I said, Ford, Chrysler, and General Motors were struggling. General Motors filed for bankruptcy. I think Chrysler filed for bankruptcy, and Chrysler, General Motors, and Ford ended up having to get bailed out by the government. So, when people think about shorting and short squeezes, people think that it's just somebody's gone for a Hail Mary play, or somebody's just trying to be, have something against some of these companies. No, there's usually a setup or a whole play behind as to why these companies are, or why these investment funds are shorting these companies, right? So, the writing is on the cards. The car companies are down, the economy is down. Car companies generally follow the way the economy goes and goes down as well. Not only that, Volkswagen or VW had lots of debts on its books. So from the fundamental perspective, it looks like a surefire hit to go short and sell. And again, this is why I don't do fundamental analysis, because things don't always appear as they seem. But for some reason, right, even though Volkswagen had all of these things against it, and it was projected to have lots of losses, it kept coming in. When the earnings came around, it came in above its projections. So it was actually doing better than it was projected, right? And what happened was is that people didn't know that Porsche Porsche had a stake in Volkswagen. The car company Porsche, they had a stake in Volkswagen, right? And they initially started with 30% of the company. They had 30% equity within the company of Volkswagen. What they also did, they also increased their stake from 30% to 44%. Okay, so now Porsche is owning 44% of Volkswagen, right? What they also went and done, which people didn't really understand, was they bought 30% or 30% of the call options. And to long story short, options are basically, it gives you the option, as it says, to buy the stock at a future date. So basically, if I own 30% of options in this company, I have the option to buy 30% of the company at a later date. So essentially, I already own that part of the company, right? So if you add 44% and you add 30%, you know, Porsche now owns 74% of Volkswagen. Why is that significant? Well, what you got to understand is that when you're talking about stocks on the stock market, we're talking about a float, right? We're talking about a float of stocks on the market. Whenever you're trading or buying any sort of stocks, you're talking about an allocated flow of stocks. So basically, the float is the amount of stocks that are available for purchasing, trading, selling, buying, and things like that, right? So although Volkswagen owns 74% of the stocks, the amount of availability of float was less than 1%, right? So the available stocks to trade and maneuver was less than 1%. So at the time, a lot of these investment funds didn't understand or didn't even realize that there was only 1% of the stocks available for float, right? So what ended up happening was Volkswagen very carefully, or Porsche, to say, you know, not so subtly, may put out a statement and basically said, hey, we're just letting everybody know that we own 74% of Volkswagen. Suddenly there was panic across the market. Why? Because people started realizing that there was not enough stocks available in the market because Volkswagen had so many stocks in order for people to exit their position. Remember, for you to be able to exit your position, there has to be the stock available in the first place in order for you to rebuy the stock and exit the position. If the stock is then not available for you to exit the position, if there's no float, you can't exit the position. Not only that, right? If there is a limited amount of stock available or float, or like, no, let's say that if there isn't any stock available or float, you have to then buy the stock from somebody, right? And if you have to buy the stock from somebody, nobody is at any obligation in order to sell the stock, right? So that person that owns the stock then can set their own price for the stock, right? They can tell you how much it costs you to exit the trade. Now, remember, these people that are in these trades are paying their, fee to their broker in order to exit the trade, right? So what happened was with Volkswagen was the fact that there was not enough stocks for people to exit the trade, and Porsche knew this. So this is why Porsche put out the message or the statement, just letting people know that, hey, there's not enough stocks for everybody to exit the trade. So if you want to exit the trade, you better be quick about it. So what happened was it was so much increased demand for the stock that the price of the stock skyrocketed. Let me go to the charts and I can show you the value of the stock. Salute Red Star. Appreciate you being in the building today, brother. Salute ISO. Appreciate you being in the building today, brother. So let me show you what the effect of the short squeeze was on Volkswagen. We kind of saw it a bit earlier. I had the chart up. So if I go and share my screen, we can see the fact that the increased demand on Volkswagen had, right? If we look at the 2008, we can see that things were traveling nicely. And then look at this massive spike we're having right here. Let me zoom in a bit. We can see this massive spike in price. It was over 1,000% increase. You can see it here on March 17th of March. You can see it there. No, see it there growing up. Wait, hold on. Where are we? Let me zoom out my chart 1 second. Let's go back. Hold on. Sorry, here's the spike. That was a different spike. This spike is even worse. This is the 1,000% spike. Look at this is the spike that we're talking about. So this is in 2008. This is 29th of October 2008. Look at the spike in that chart. Let me. Now this spike was caused because, as I said, Porsche let people know that there is not enough stocks available for people to exit their position, right? So if I can get into a 1-day zoom to get a bit closer. If we bring out our ruler, we can see that the percentage growth for that day was crazy. Look at that percentage growth that we're talking about, right? So this is what we call a short squeeze. So now imagine the stock going from, where was we? It was around the $47 area up into $117 per share, right? So this is what we're talking about, a squeeze, when the price goes up super high and people are unable to exit their position because they are now squeezed in their position because they can't exit. The price or the cost is either more than they want to pay because they don't want to incur those losses, or it's a thing that they can't even afford to exit the position and they have to just keep paying their daily rate and hope that the price falls in order for them to now come to a price where they can actually exit their position. Okay, so this is, historically what a short squeeze is. It's either the fact that you can't afford to exit your position, or there are not enough stocks available for you to exit your position. Now, when there are not enough stocks for you to exit your position, they call that a gamma squeeze. They call it a gamma squeeze because isn't even physically possible for you to exit your position if it's not available for you to, any stocks available for you to exit your position, right? So now we're looking at the price could go to anything. The price is whatever you want it to be because the person can't exit their position. And it's like, how bad do you want to exit your position? Now, if you're a person that also owned the stock in the original first place, you're getting paid a daily rate for loaning out the stock. So it's not something that you would want to resolve itself anyway. So there are people that have investments in doing that. And there are multiple other ways in which you can push up the value of the price of the stock. Another thing is, again, options, as we talk about options, right? So options, as we spoke about earlier, is where you have the option to buy a stock at a later date, right? So let's say, for instance, again, going back to our example, similar to how we spoke about earlier, let's say, for instance, a stock is $100. Let me go back to my illustration, and this is a good way to explain options. Let me bring up my screen. We're gonna explain what options are, right? And options are important because options can also push up the price of a stock as well. Where are we? Here. Let's go back to our illustration. Let's make sure you guys can see that. Can we see this? There we go. All right. Let me bring this here 1 second. All right, so let's go back. So an option works by, let's say for instance, we're just going to focus on the market. So if the market says that the value of the stock is $100, right? You can now purchase an option. So the value of the stock is $100. We believe that in 7 days, that the value of the stock is going to go from $100 to $200, right? So we're going back to our broker again. Celia is our broker, right? So similar story. We pay a rental fee or a loan fee. No, we don't pay. We pay. That's not correct. We pay a fee to the broker in order to get the option. So the option says on the contract, in 7 days, we can buy this stock for $100, right? So it's a risk, right? If the stock ends up going down to $50, let me draw this in. So if the stock ends up going down to $50, right? That means that we've basically wasted our money because we've bought the option to buy at $100. And why would you want to buy a $100 stock? Why would you want to buy a $50 stock for $50, right? You have the option to do so, but generally what would happen is you will not exercise the option to do so, and therefore that option will expire, right? But conversely, let's say for instance, you bought this option of buying the stock for $100, right? But now 7 days later, the stock has gone up to $200, right? But remember, you have this option. It's like exactly what it says on the tin. It's an option. You have the option to buy a $200 stock for $100, right? So this is how you make your money. You make $100 because you're buying a $200 stock for $100. Now, obviously, you got fees and things in between that, but we're keeping it simple here so people can understand it. So when people talk about options, you're talking about the options to buy a asset at on a future date at a certain price, right? You're buying a $200 stock for $100 or $200 asset for $100, right? And conversely, the other way around, right? It's the same thing with shorting. Right, shorting, you can have the option to sell at a certain price, right? So say for instance, let's say for instance, you bought the option for $200, right? You have the option to sell at $200. If the asset goes down to $100, you have the option to sell a $100 asset for $200, right? You're talking about options in the future. You have the option to do so in the future, right? So why is this important? Well, why is this important is because, whenever you take out an option with a broker, the broker hedges your option, right? So say for instance, Celia is the broker. If you take out an option on AMC stock in the future, saying that in the future I have the option to buy AMC at a certain price, what the broker will do to hedge their bets will actually buy the AMC stock, right? So they buy it so they can hedge their bet in the future. So now they have the option to get the stock. The broker already has the stock, right? So this is the hedging against what's going on with the AMC stock, right? So why is this interesting? This is interesting because when the purchaser takes out the option and the broker buys the AMC stock, what does a purchasing of AMC stock do to the price or do to demand? Let me see if chat is paying attention. When at this point, when the option is taken and the broker now buys the stock and hedges the bet against the price of against the option of AMC, what does it do for the price of AMC? Remember we spoke about this earlier, supply and demand. We talk about what buying does for the price of a stock, what increased demand for the stock does, right? So think about that. If a lot of people start taking options on AMC, what does so that gives a lot of options. That means, you know, the broker now wants to hedge their bet even more. So the broker will start buying more AMC shares, right? So when the broker buys more AMC shares, exactly, this is what Caesar says, increase the price. Somebody paying attention. Right. So the more people, again, Neil Smith says raises the price, right? So remember, we're talking about a short squeeze or a gamma squeeze. So number one, we're talking about the price already has gone up so that these investors can't exit their position. The second thing could be also that there are not enough stocks available for people to even exit their position, right? The next thing is if people are taking options on, so here's the next thing, right? So people are seeing the value of the stock going up. So they're saying, wow, the stock is going up. So the news starts going on. Everybody starts getting hype about the stock going up. So again, when people see the stock going up, that gives more frenzy. This gives more energy and more excitement to the stock going up. So what is that people going to do when people see the stock going up? That increases more people to start buying the stock, right? So now you're talking about, more people buying the stock again, increasing the demand. So this is where we're talking about a gamma squeeze where, it keeps increasing itself to keep pushing the price up. The price keeps going up, keeps going up, keeps going up because people keep seeing this and keep seeing the opportunity to make money in this thing, and they keep raising the price, and it doesn't allow people to exit the trade. So this is what we call a gamma squeeze, right? It's those three things. It's the fact that the price is going up, it's the fact that there aren't that many stocks available, and also there's a lot of hype and sentiment around something, and it keeps pushing it up. So this is what we saw with GameStop, and we saw with AMC. Right now, there's a lot of excitement around the actual asset, which is why it's pushing the value of the stock up, right? So are we with each other so far? We're clear so far, right? So before we kind of go into reviewing the AMC chart to see where we actually are, I'm going to break down what margins are, because we keep hearing the term of margin call, people getting it margin called, right? So what is margin and a margin call? So before we go any further, just a reminder that if you haven't done so already, please hit the like button. If you're enjoying the content, hit the subscribe button as well. If you would like to support the show, you can support the show. If you value the information that we're delivering here, if you value your financial future and you think these shows are worth it, you can hit the cash up on #, focus on investing. The cash app is #, focus on investing. If you would like to support the show, you can do so. All right. So what is margin? When we keep hearing the term margin and margin calls, what does that mean exactly? All right. So let's go to in our good old trusty friend Investopedia and look at the definition of what exactly margin is. And then we'll go down and break down exactly how margin works, right? Wait for this to pop up. I don't know if it's just my end that's slow bringing it up or if it's slow for everybody. But here we're on, there we go. So we're on Investopedia. And this is an Investopedia article called What is Margin? So in finance, the margin is the collateral that an investor has to deposit with their broker or exchange to cover the credit risk the holder possesses for the broker or the exchange, right? So in our example, the broker and the exchange is the same thing, right? An investor can create credit risk, right? So you're creating credit, create a credit risk if they borrow. So we're borrowing cash from the broker to buy financial instruments. Let me read that again. So they can borrow cash from the broker to buy financial instruments, borrow financial instruments to sell them short or to enter into a derivative contract, right? So again, we're talking about an investor creating a credit risk by borrowing cash, from the broker to buy financial instruments in order to sell them short, right? So this is where we're talking about short squeezes and margins, right? Buying on margin occurs when an investor buys an asset by borrowing the balance from the broker. Buying on margin refers to the initial payment made to the broker for the asset. The investor uses the marginable security in their brokerage account as collateral. Don't worry, we're going to go into all of these things and break it down even more. In general business context, the margin is the difference between a product, service, selling price, and the cost of production. This is outside of trading, right? Or the ratio or profit to revenue. Margin can also refer to the portion of interest rate on an adjustable rate mortgage added to the adjustment index rate. So this last paragraph just refers to general business, right? So key takeaways. The key takeaway is margin is the money borrowed from a broker to purchase an investment and is the difference between the total value of an investment and the loan amount. Margin refers to the practice of using borrowed funds from a broker to trade a financial asset, which forms the collateral for the loan from a broker. A margin account is a standard brokerage account in which the investor is allowed to use the current cash or securities in their account as collateral for a loan. Leverage conferred by margin will tend to amplify both gains and losses. I'm going to read that again because this is very important. Leverage conferred by margin will tend to amplify both gains and losses, right? So it will amplify both. In the event of a loss, a margin call may require your broker to liquidate securities without prior consent. Okay, so we're going to go into now breaking down exactly what margin is, right? So let me share back my original screen. All right. So in this case, wait for it to load up. This time, I don't know why it's acting slow today, but it is. So we're going to go into an illustration of exactly what margin is. Let me set this up. So In this example, let's see if I can ease up. Technical difficulties. Hold on. All right. Excuse the technical difficulties. Let's go back again. Let's see if it'll allow me to share my screen. Oh, there we go. All right. So let's say, for instance, so to make it clearer, we're going to change Celia out for a broker image, just so we get a better idea. Let's use this image as our broker, right? So we have our broker, and our broker allows us to have margin or a margin account, right? So what is margin? Margin is basically saying a margin account is like another way of saying like an account that allows you to have credit, or like you can say it's like a deposit account, right? You pay a certain amount of deposit in order for you to utilize a greater amount of money, right? So in our example, our let's say our broker says that, you know, our initial margin requirement is 50%, right? Whenever you're going to a broker will tell you what percentage of the margin like the broker set. So let's say, for instance, see if this comes up. So our initial margin requirement okay. Let's move this out of the way. Initial margin requirement is, we're going to say 50%, right? And then let me might as well write it here as well. Now this is going to become important later. They have something, as well as an initial margin requirement, you have something called a maintenance margin. Maintenance. I spelled that wrong. So our maintenance margin is 35%. Yeah. Okay, so we're clear on that, right? So again, our maintenance, so our initial margin requirement is 50%, and our maintenance margin is 35%, right? So if our initial margin requirement is 50%, let's say, for instance, we've got a trading account. In our trading account, we have 5,000 dollars to invest, right? We go to our broker. Our broker says, okay, because we have a 50%, margin requirement, if you put up 5,000, the broker will actually loan you another 5,000, right? And allow you to have 10,000, right? You can trade with 10,000. You can trade with 10,000 by only having 5,000. Okay. Let me make that bolder so you can see it. All right. So there is now 10,000 for you to trade with, right? Now remember, 5,000 of that is equity, which is basically what you own, and 5,000 of that is debt, because it's a loan. You're basically taking out a loan from the broker. Now again, don't forget there are fees involved in here, but we're not putting the fees on top just to keep the math simple, right? So let's say, for instance, the market, I delete my market thing. Hold on. Let's go here. Let's say the market goes up by the market is up by 25 cents. Where's my percentage symbol? There you go. So the market is up by 25. Right. So if we look at the market going up by 25%, an increase of 25% on our 10,000 we end up having $12,500 we've made. From that $12,500, we'd end up paying back our $500 back to the broker. So the broker would then get their 500 back. Yeah, 500 back. Also, don't forget they would have made fees from that. So now you would be down to $7,500, right? So now you're looking at, you've made 50% increase, right? Because you started off with $5,000 and now you ended up with $7,500, right? So you've made a 50% increase on your money, with the market only going up by 25%, right? Is that clear? Let's give me a one in chat if you're with me so far, if that's clear. Let me know I haven't lost you. By taking margin, we've actually amplified our winnings, right? So technically, or in reality, the market has gone up by 25%. However, we've made a 50% increase, right? Because if we take 50% of 5,000 is 2,500, and 2,500 plus 5,000 equals 7,500. So it's 7,500 is a 50% increase. All right. Neil says clear. Celia says clear. All right. So we're clear. So how does this work in reverse? Okay. Let me get rid of this. So let's go back to our example now. Let's say, for instance, rather than the market being up by 25%, the market went down by 25%, right? So the market being down by 25% means that instead of having 12,500, you now have 7,500, right? Because remember, we started off with 10,000 and the market went down by 25%. So now it's worth 7,500. Remember, you still have to pay back the 500 to the broker, right? So if you pay back your 500 to the broker, how much does that leave you with? That leaves you with 7. No, wait, hold on. What's my maths going on? Hold on. We was at 7,500. And then it's 5,000. This is why I'm getting confused. It's 5,000 you owe the broker, not 500. Excuse me. Because remember, we started in the beginning with 5,000. That was the 50% margin. So we now have 10,000 in order to trade, right? We had for the 10,000 was 5,000 of our own money, which was equity, 5,000, which was debt, which is our margin from the broker that allows us to borrow that money. We put 10,000 trade on. That trade, we lost 25%. So that trade is now worth 7,500, right? We give back our 5,000 to the broker, and that would leave us with 2,500, right? I just want to make sure that everybody is clear, right? So now if we do 2,000, let me write in here. So if we do 2,500 divided by, and then we look at what our original was, 7,500, which is the value of the trade, that equals 33.33%. Okay, so this is how much. Move this so it's a bit clearer for people. This is how much equity we have in the trade, right? We have 2,500 equity in the trade, but the total value of the trade is currently 7,500. You know, we have a maintenance margin of 35%. Because the trade went down, or the value of the trade went down, or the market went down, you know, we fell below our 35% maintenance margin requirement, right? So the value of this trade, or the margin, is actually at 33%, right? So this is when you have the options, right? This is when you get what they call a margin call. This is when people say margin call. This is what is meant by a margin call. This is when your broker picks up the phone and says, "Hey, Neil, you know, we know that you've got this trade going on in AMC. You expected the trade to go in a certain direction. However, the direction of the trade has gone against you, and the trade went 25% in the opposite direction to the way you perceived that it was going to go. Therefore, the value or your margin within this trade is actually only 33%. So I'm giving you a call about your margin. This is the margin call, right? Obviously nowadays you have, electronic brokers, so most of the time you don't even actually get the phone call. It's just like a notification you'll get through your broker software or whatnot, right? So this is what they call a margin call. So now at this point, Neil has two decisions to make, right? Neil can either, ride out the trade by by um by adding more funds to his account and then increasing, his margin to above the requirement of the 35% maintenance margin, right? Or if he can't pay the money or doesn't put the money in, what the broker will do again is sell the asset and therefore um, take their percentage out of the trade, right? So this is what we saw with this. They will remove their 5,000, and this is how you end up with the 2,500, right? So if we look here, we can see that, what Neil has in this trade is an equity of 2,500, right? So 2,500 is a loss of 50% of the initial amount that he put in. He put in 5,000 and now he has 2,500. Remember, the market only went down 25%. However, he's managed to amplify his losses by 50%, right? So 2,500 is 50% or half of 5,000. So the margin has managed to amplify his losses, right? So again, to clarify, if Neil doesn't add money to his account, he will get a call from the broker about his margin. He will get a margin call letting him know that he either needs to put more money into his account in order to keep this trade open, or the broker, as we've put here, will claim back their 5,000 margin by selling the asset that he purchased in order for them to get their money back. Is that clear? Can I get a one in the chat if that's clear on what margin calls are and also how margin amplifies your wins and amplifies your losses? If everybody is with me, let me get a one in the chat to make sure that is clear. So when we hear the term, all right, ISOs gives me a one. If it's not clear, let me know now and I can kind of go over it some more. So everybody seems to be clear on that. All right. Neil says clear as well. All right then. So let's have a brief recap of what we've covered, right? We've covered, what shorting is. Celia says one as well. And we understand what shorting is. We understand what a short squeeze is. A short squeeze is when you are unable to exit the trade because there is either the price is too high, there is not enough stock available to go around, and also there might be added hype, so everybody keeps buying and pushing up the price of the stock, right? We understand that a margin call is when, an investor takes out a loan from the broker in order to amplify the results of their trade. So that can amplify the wins, or it can also amplify the losses, right? There's another thing. There's a thing that they call naked shorts. So naked shorts are essentially, this goes back to short selling, right? When a naked short is basically when something or an asset is shorted or stock is shorted more than the available stocks that is about, right? So people say, how do you short the stock more than possible? Okay, so we need to cover this as well. Let's say, for instance, let's get rid of this. See what we can use for companies. Let's say company. Oh, let's just do this. Just do it by type. Let's say we have AMC, right? AMC, and AMC issues 100 shares, right? If AMC issues 100 shares, then there's only a total of 100 shares, right? Let me do this. If AMC issues 100 shares and Neil buys 100 shares, or let me say Neil borrows 100 shares, he now has 100 shares. Right? Neil then sells his 100 shares. Let me pull this so it's a bit easier. Neil then sells his 100 shares to an institution, right? So 100 shares have been sold. Along comes Celia, right? And Celia then borrows 100 shares. Can I duplicate this? Let me type it again. Celia then borrows 100 shares from this institution. So she borrows the 100 shares from the institution. And then she then sells those 100 shares that she bought to another institution, right? So we're looking at a situation where AMC has only issued 100 shares, yet there has been 200 shares sold. Do you understand that? Because it was sold initially by Neil and then to the institution borrowed those shares to Celia, and then Celia then sold those shares. So there were 200 shares worth of AMC that was sold, even though there was only 100 AMC shares available, right? Is that clear? So this is what we're talking about, naked shorts, right? So this is when you're talking about something being shorted more than the amount that there are shares available, right? So when you say, so in this case, AMC shares would be shorted 200%. And people will be wondering, how do you short something 200%? How do you short more than is available? This is something that happens. And why this is something that goes on is because it affects the price of the share, right? This is what some of these investors do. Remember, if buying the share pushes the price up, then selling the share pushes the price down. So if I'm shorting and I'm short on an asset, I want to do or see whatever goes on in order to increase the price to go down. If people are selling the share, that's the market. So people are selling it. Therefore, it will bring the price down, right? But here's the thing. In terms of salute to Order of Caligula in the building, good to see you. So, in order to now exit your position from a short squeeze, there are 200 shares worth of shorts out here, but there is only 100 shares available, right? So there is not enough shares in order for people to exit their position because there are more shares shorted than there are actual shares that exist. Is that clear? So there's only 100 shares, yet there are 200 shorts, right? So if, for instance, we now, this 100 shares cancels out the initial, or cancels out this 100 shares, there is still 100 shares of shorts outstanding, right? So now you're in trouble, because now you can't exit your position, right? This is not, you're not able to exit your trade, because you have more shares sold than is available to be sold, right? Are we clear? Right. So now we understand all the factors that go into making a short squeeze, right? Again, let's reiterate. A short squeeze is when somebody or an institution or a person shorts a stock because they expect it to go down. They borrow the stock from somewhere, sell it with the expectation that it will go down and they can repurchase it at a cheaper price. A short squeeze occurs when the price, number one, the price goes up. Number two, the short squeeze occurs when there are not enough stocks available to buy. That's because, again, it's either oversold, or they're in the case of VW or Volkswagen, that there is not enough shares available. And the last thing is the sentiment, the market sentiment. There's a lot of excitement around the stock, so everybody goes out and buys the stock, right? And again, this can happen with options, people buying options because they see the value of the stock going up, and therefore the broker covers the option call by buying the stock at a current price, and that also again pushes the price up. And again, I've said shares here, but I'm using stocks and shares interchangeably here, right? This is what we're talking about. All right, so let's take a look at AMC. Let's go to our charts and look at AMC. Where are we? Make sure you guys can see this. AMC Entertainment Holdings. Let's reset the chart. All right, so this, let's do it this way. If we go to, getting our DeLorean, our Marty McFly, and we go back to here, right? This is where we saw the beginning of the short squeeze, right? Again, this is what date are we at? This is in May 2021. So we know the situation, what happened in 2020. A lot of people were unable to go to the cinema. Therefore, a lot of these investment funds believe that they believe that the cinema is on its last legs, and that the cinema is actually going to go out of business. So a lot of these investors shorted the company, believing that it will go out of business due to the current situation that was happening in 2020. What ended up happening is actually people started getting emotionally attached to AMC, and that's generally because of, firstly, we saw what happened, in the pandemic, and with the whole what do you call them, Wall Street bets, right? Wall Street bets saw the opportunity that actually this company is being overshorted. There were lots of naked shorts, meaning that it was shorted more than the available stocks that were available. Salute to Stun Legacy. Good to see you in the building. There were more short stocks than were available. So this was identified. So This was brought up onto um, Wall Street Bets, and the opportunity to short was made known. This was hand in hand again with when we talk about public sentiment, right? We're talking about people that had an emotional attachment to AMC, right? They had an emotional attachment because, people had the knowledge, or the memory of them going back, when they were children, watching all of their favorite films, even as adults. They had an emotional attachment to these things. And with the emotional attachment, people didn't want to see this brand die. Again, this is a fundamental play because this again goes back to emotion. Also, it it came about because the whole 2020 situation and everything that was going on around it. A lot of people were against the status quo or the government or the way things were going, and the whole play was looked at as a middle finger to institutions. It was a way to get back at these institutions, right? So that's why I said it was a very emotional play. It's an emotional play to do this. So let's go back to what we was talking about. In order to have a short squeeze, what do we need price to be doing? What is this? The squeeze in the short squeeze? Let me see what if chat is paying attention. In order to have a short squeeze, as we've explained, what do we need price to be doing to be squeezing the short investors? Let me see who was paying attention. What is the squeeze in short squeeze? What do we need price to be doing in order to short squeeze? Celia says price going up. Where, let me just highlight. Price going up. Correct. We need price going up. Right. Price going up is as order of is buying pressure. Yep. When price goes up. Correct. Right. And the squeeze comes because when the price goes up, it makes it more expensive for you to exit your position. Right? No worries, ISO. Right? When the squeeze comes from, you need the price to go down below the price that you entered the trade in order for you to exit and to make money. Right? But if we take a look at AMC, what happened was we had the short squeeze, right? Everything happened. People got involved in the short squeeze and the price raised up. But then what we saw subsequently, if we hit the play button, let me speed it up a bit. Oh, where are we? There we go. So we look over time. We saw, remember, in order for us to squeeze investors, we need the price to continue to go up in order for them to be squeezed out of the position. Right. So this is the time of AMC going forward, right? We're looking through, this is August 2021. As we're going through, let me see in the chat. Looking at this chart pattern, if this is our high, this level here, let me draw in a line. Oops. Hit the wrong button. There we go. If this is our high, is price going up or down from our high? Are we getting a squeeze or is it releasing price? If for a short squeeze, we need price to go up. On this chart, is price going up or is price going down? This is the price of AMC over time. over time, is the price going up or is the price going down? See, it says, as young Jock would say, it's going down.
It's going down.
Star Legacy says down. Order says, what, the AMC, the price is article. What do you mean? Did you mean artificial? Is that what you meant? Forming lower lows, right? So ISO said it could be price manipulation. It could be. It could be price manipulation, right? But the thing is, even if it is price manipulation, is it a squeeze? This is the question you have to ask. And the question you have to ask is, even if it is price manipulation, do you expect that these organizations will play fairly with you? This is the question you have to ask, right? So, when people speak about short squeezes, you have to understand a short squeeze is basis or based on price going up, right? If the price is going down and you are able to buy the stock at a cheaper price, therefore there is not an actual squeeze going on because the price is going down is in a short fashion, which the short squeeze is supposed to be against, right? If you're shorting a stock, you're expecting the stock to go down. So those who are shorted are agreeing with you that it's going down. So the people that have shorted the stock are actually making money on the stock, and those people that have gone long on the stock or have bought the stock are not making money on the stock, right? So the short squeeze for AMC was at this point here, right? The short squeeze was when we was talking from the 21st of May or 24th of May all the way up to the beginning of June. That is when the squeeze was in play. The reason why it was squeezed is because there wasn't a available stock, or the price was too high for people to exit their position, right? If the price is going down, that means people have the availability to exit their position, right? So people are saying it might be artificially manipulated. Maybe so, but even if it's artificially manipulated, if you have the ability to buy stock, then you can still exit your position, right? Think about this. Short squeezing is based on the inability for people to not be able to exit their position. If you can buy a stock, that means there isn't a squeeze because people can exit their position, right? If you can buy a stock for $11, that means there is not a squeeze on price, even if it is being manipulated, or even if you're looking at, it being artificially manipulated. If you have the ability to buy the stock, that means whoever is going short on the stock has the ability to also exit the stock. Not only that as well, the more the price goes down, the more it brings down the whole market in the total, right? So as conversely as the price going up increases the squeeze, the price going down also releases the squeeze, right? So when we're looking at a short squeeze, a key component of a short squeeze is the price going up in order to squeeze it. If the price is going down, therefore that means there is not a squeeze going on, right? So again, if the price is going down, it's making it easier for people to exit their position rather than it being harder for people to exit their position. So we just have to be clear on the definition of what a short squeeze is, because we have to get out of this mindset of being emotional when it comes to stocks and understanding what it is. And I'm not saying that, nobody really knows whether or not the market is being manipulated or not. But my thing is this: why wait for this stock to blow up and go up when there are stocks that are going up now, right? And if you're talking about, something being manipulated, who's to say that the manipulation won't continue to the end? We saw what happened with the financial crisis, right? People got the people that were in power got bailed out rather than, got held accountable, right? So, it's just about us understanding the definition of what we're talking about. When we're looking at this situation or this setup is not a short squeeze setup simply because the price is going down and the price is not going up, right? The price going up took place here. This was the short squeeze here in this situation here from the 24th of May and the 21st of May to the 2nd of June. That was the squeeze. When price started releasing, this is when the release of the squeeze happened. Is that clear? I know a lot of people are unhappy to hear that. Are we clear on that? Do we have any questions on this? I see ISO said it means that AMC is worth more in price, but the guys are holding it down. How can it be worth more in price if how can it be worth more in price if I can buy it for a certain price? Right? I'm clicking the wrong message, right? Think about this. It's like me saying if I buy it's like me saying the stock is worth $100, but yet you can buy it for $2. If I can buy a stock for $2, is it worth $2 or is it worth $100? Think about it, right? He's saying if you're saying it's worth more, how can it be worth more if I can buy it at a cheaper price right now? I can buy AMC for $11, right? So ISO says dark pool is $6,000. So if I can buy a stock for $11,000, is the value of the stock $11,000 or is it $6,000? Who would pay $6,000 for a stock that can be bought for $11? Think about that. What is the value of the stock? If we're saying the dark pool is worth $6,000, or I can buy it on the open market for $11, what is the value of the stock? Think about it this way as well, right? If let's say for instance, a pair of Jordans come out, right? Nike issues a pair of Jordans for $11, right? On the resale market, I resell the Jordans for $6,000. I am well within my right to sell it on the resale market for $6,000. But if you can still go into the shop and buy it off the shelf for $11, then which one is it really worth? Is it worth $11 or is it worth $6,000? This is the question. If the item can be bought for $11, why would somebody pay $6,000 for it? This is the question. I'm asking chat. What do you think? would it be worth $11 or would it be worth $6,000? Let me see what the sentiment is. If somebody is selling something for $6,000, yet you can buy it on the open market for $11, what is the true value of the thing? Remember, if we're talking about supply and demand, we're talking about availability and scarcity, controlling price, and this thing has availability and is available for $11. I can buy it for $11. You can buy it for $11. Then is it worth $11 or $6,000? This is the question. Let me see what the chat says. Right, the squeeze is the inability for you to be able to exit your position. Remember, this is what the squeeze is. This is what a margin call comes, because the margin call comes because you're being called because the stock is going into the opposite direction than you want it to be, right? So it doesn't allow you to exit your position. However, if you've bet for the stock to go short, which is for the price to go down, and the price is going down, it's not going opposite to the direction that you want to be, and therefore you're not being squeezed out of your position. You know, if the price is going lower and you can exit your, if anybody can buy stock for a lower amount, that means you can exit your position, right? If people can buy the stock for this price, that means the investment funds can also exit their position at this price, right? So Celia asks, is it worth you to buy it for at that time? I'm assuming you meant, is it worth to buy it at that price at that time? Well, this is the question, right? If you're buying it specifically for a short squeeze play, and we know in order for there to be a short squeeze, price has to go up and price is going down, then is it really a short squeeze play? This is what we have to ask the question. Okay. Celia says it would be worth 11. Neil says, on the face of it, it would be worth the buy price. Right. It's worth whatever you can buy it for. Right. So Neil says, if the true price is just $11, as we are told, why did big money buy more of it? Well, more people didn't buy more of it. That's why the price went down. More people sold it than bought it. Do you understand what I'm saying? If people had kept buying it, people were buying it here. Remember, when we're talking about the short squeeze, a lot of these investment funds, they went short. They didn't buy, they went short. This is what the short was, right? They only bought it in order to exit their position, right? Think about it. When you're shorting, you have to buy in order to exit your position. You have to rebuy to exit your position. Remember how we broke down what the two parts of the short squeeze was? You borrow the stock, you sell the stock, and you rebuy at a lower price, right? So by this time, you know, everybody would have rebought it at the lower price, which would have allowed them to exit their position, right? This is what the short squeeze is based on. The short squeeze is based on people not being able to exit their position because the price is too high. But we can clearly see on the chart with our own eyes the price that the stock is available at $11. And whether you believe it's being manipulated or not, if you have the ability to buy the stock at $11, then those people that are shorting that want to exit their trade can also exit at $11, right? So again, why big money would buy more of it, they would buy it in order to exit their position. And we can see that by the charts, the overall sentiment is that people are not buying the stock. If the people were buying the stock would continue to go up. The overall sentiment of big money and everybody is the price is going down. Again, remember, this is why we utilize technical analysis rather than fundamental analysis. Remember, fundamental analysis is based on hearsay. It's based on news, noise, and confusion. This is what we keep talking about, right? So we're saying, oh, the true price is this. We've heard that it's being suppressed. All of those may be true, but again, it may not be true. So this is again when we start getting into hearsay and guessing whether or not something is worth something or not, right? When we're talking about technical analysis, we're talking about being able to see the actual price. Anybody can go here right now, look at the price of what this asset is worth. Not only can you look at the price, you can buy it for that price, right? So what is more likely? Being able to see and purchase the asset at a certain price, or being told that it's worth a certain amount of value when it can't be done. Order of Caligula says, what about glitches? I'm not understanding what you mean by glitches. If you can elaborate on glitches. Right. So here we can clearly see that the value of this stock is down. It's going down, right? Do we understand that? Like the value of the stock is not going up. You can perceive, like you have tangible information in front of you to be able to see. So this is, again, this goes back to why I speak about technical analysis over fundamental analysis, because again, maybe the price is being manipulated, but even if it is being manipulated, it's being manipulated to the point that the price you can buy the stock for $11. If you can buy the stock for $11, then we don't have the component of a short squeeze, because the component of a short squeeze is that, number one, that the price is either too high for these investment funds to exit the stock, or there is no stock available, so they have to come to you and you get to name your price, right? If you can buy the stock at $11, then clearly there is stock available, and therefore people do not need to come to you and ask your price. Not only that, because the price is going down, that is showing you that there is not demand for the stock. If there is not demand for the stock, that means that there is lots of stock available. And again, if there is lots of stock available, that allows people that who are in the stock that were short to exit their trade. Is that clear? So ISO says, write it down, but it can bounce back too. True, it can bounce back too. But if it bounces back, is that really a short squeeze? That's just right. Remember, we're talking about AMC because AMC is supposed to be a short squeeze. At this point, it's not a short squeeze, right? Because if this bounces back, that's like any other stock. Any stock at a certain price you can buy, and it could potentially bounce back. Of course, it can bounce back, but any stock can bounce back, right? There's no guarantee that it will bounce back, right? But is that a short squeeze if it bounced back? Not really, right? A short squeeze is a specific set of conditions, right? It's a set of conditions where the investment funds can't escape, and they intended to get involved in this because they perceived that AMC was going to be down because of the economy, right? Now that that situation has resolved itself, this was the short squeeze here, and now the squeeze has released itself. It's actually similar prices to before the short squeeze that we're at now, right? So can it bounce back? It can bounce back, but then are we still talking about a short squeeze? Order of Caligula says the glitches show the price of AMC being much higher than we are seeing in the actual market. Then how does that make sense, right? Think about what you're saying. the glitches show that the price of AMC is much higher than we are seeing. The actual price is the actual price that you can buy it for, right? Think about that. If I can buy it for $11, then that is the actual price, right? You're saying, so the statement that the price being high, so the higher let me read it again. The glitches show that the price of AMC being much higher than what we are seeing in actual markets. How can the price be higher than what we're seeing in the markets? The only way the price can be higher than in the markets is if the markets are saying $11, but you can't buy stock for $11. If you can buy stock for $11, then that is the actual price, right? So Kalinga says, but what if a lot of buyer pressure is being stolen, helping the price looking lower than what it is? Maybe so. But if you can buy it for this price, then there is no short squeeze. Do you understand what I'm saying? The short squeeze is dependent on people of the investment funds not being able to exit their position, and therefore being the people that own the stock naming their price for people to exit their position. If you can buy the stock, then there is no short squeeze, because just as you can buy it, the investment funds with more money than you have can also buy the stock and exit their position. If they can exit their position, then these funds don't need to come to you and ask for you to give up the stock, right? Even if it's artificially being suppressed, if there is availability of stock, then they can exit their position. You understand? Do you understand what I'm saying? It's like collector's editions, right? Let's say, for instance, you have a comic. There were only 10, issues of these comics. Let's do NFTs. NFTs. Most people. No, let me not do NFTs because some people don't understand what NFTs are. So let's just say a comic. Let's say there's one issue of a special edition comic available. Or let's say it this way. I don't know if you remember, there's a guy called Martin Shkreli, I think his name is, and there's a rap group called the Wu-Tang Clan. The rap group called the Wu-Tang Clan they produced an album and they only made one copy, and I forget how much they sold it for. I think it was a certain amount of millions. I don't know if anyone can remember how much Wu-Tang Clan um, um, put it in. If you can remember how much Wu-Tang Clan sold the album for, you can put it into the chat, right? I can't remember, it was X amount of millions. So anyway, this Martin Shkreli guy, he's not very popular with the public. He was actually known for, I think, buying some key vaccines or something, and not allowing people to get the vaccines or whatever it was. But he bought this Wu-Tang Clan album, and I think it went to the highest bidder. So basically, because he paid the most money, he had the ownership and control of this album. And I think he allowed people to hear a few tracks of it, but the whole album I don't think has been heard by anybody because he owns it, right? So that album was worth X amount of millions. The reason why it was worth X amount of millions was because there was only one of it. It was very rare. Because it was rare, nobody else can get that album. If anybody wants to hear that album or get access to that album, then they would have to pay, however many. They would have to come to this Martin Shkreli guy, and he would get to name his price, right? Because there are no other albums available for people to buy. Say Celia says 4 million. So he paid 4 million for one Wu-Tang Clan album, and only he owns and controls it, right? So he paid 4 million, but in order for anybody else to get hold of that album, because there's only one album available, he gets the ability to name his price in order to buy that album, right? So that's because it's very scarce. There is none available. However, if Wu-Tang Clan decided tomorrow that actually we're going to turn around and issue another million worth of those albums. That means if somebody wanted to hear that album, they don't have to go and pay, the 4 million plus price to Martin Shkreli. They can go, $9.99 or whatever physical albums cost in a shop and buy it. So the question would be, is the album worth the 4 million at this point that, Martin Shkreli is selling it for, or is it worth the $9.99? It's worth the $9.99 because your ability to buy it for $9.99 and get access to the thing determines the price. The market is telling you the price. If you can go to the market and buy it for a price, then that is the market price. That is the price of something. Whether or not Martin Shkreli decides that he wants to sell it for 4 million or not, whether he sells it on the open market, on the secret market, on the gray market, on the black market, on the dark market, on the dark pool, whatever you want to call it, he can set his price. But if it's available, on the open market for a certain price, and anybody can go and access it for that price, then you can get it for that price. So Olaf Kaliga says, I even the fundamentals of what a short squeeze is. I know that we do not meet conditions currently. However, I do think that we are there soon, based off of everything going on in the MSN community. In the MSN currently, what does MSN stand for? I'm not sure. All right. So, but you have to understand what creates the short squeeze, right? When you're saying we do not currently meet the conditions of a short squeeze, if we don't currently meet the conditions of a short squeeze, then there is no short squeeze, right? So a short squeeze is kind of like a thing where the situations have to, the situation has to manifest itself, and then people identify the short squeeze and come in behind it and do it, right? The short squeeze is based on naivety of investment funds going in the wrong direction. They're not going to now come in and short it and everybody rush in at the same time and push the price up. Number one, because those people that got into the short squeeze and have the fear, like we talk about, and are selling it, will not allow the price to rise high enough. There are people right now that would exit their position, anywhere above this. So we're at $11 now. There's people that will exit at $20, $25, $30, $35, $40, $50. Like, there are people all the way up that will exit their position, right? So it's very unlikely that price will even get to a point where it can squeeze and people can't exit their position, right? Or MSN equals mainstream news. Okay, I got you, right? So, but again, when we're talking about mainstream news, you're talking about news, noise, and confusion. We don't pay attention to what the news is saying. We don't pay attention to opinion. We look at what the chart says. Understanding how to read and understand charts is where we base our investment from, right? This is what we base our investment on and our knowledge on. We're based on what we can see, right? And again, Celia says, so a short squeeze happens only when price goes up, right? That's correct. That is what the squeeze is. The squeeze is the price goes up so high that people cannot exit their positions. And this is who you're squeezing. You're squeezing the people that cannot exit their positions, right? So if the price is not going up, then there is not a squeeze. The price going down is more favorable to the shorters. The shorters are not being squeezed, they're actually being released, or they're being placated to, right? Somebody who sold at the height of this, who went short, is actually correct, right? This chart is favoring people rather than this chart is favoring people that went short rather than going against people that went short, right? Does that make sense? If you went short on this chart, you would make money because the price is going down. Remember, we spoke about shorting. Shorting is the fact that you're going to make money from the price going down. If you had shorted this stock since the 2nd of June, any time since the 2nd of June, you would have made money. Conversely, if you had bought any time since the 2nd of June, you would be losing money, right? Is that clear? The short squeeze took place all the way up until the 2nd of June. The moment the price started going down, the short squeeze was finished, right? Because you are now no longer squeezing, you're releasing. The squeeze comes from price going up and remaining high, and people are being squeezed because they can't exit their position and they have to continually pay their fees to the broker who they borrowed the stock from, right? The moment the price starts coming down, you're no longer being squeezed because it becomes more and more affordable and accessible for you to exit the trade. Once it becomes affordable for people to exit the trade, they no longer are squeezed because they now have the option to exit the trade. Not only do they have the option to exit the trade, there is nobody to then come to people who own the stock and to ask them to name their price. They don't need to name their price because, number one, there is stock available, because we can see here that stock is available because demand for the stock is down. So there's a lot of availability for the stock. And also the price is low enough for people to be able to exit. Remember, again, let's clarify again. The things that we need in order to have a short squeeze, we either need price to be so high that it's higher than what people bought the stock for in the initial place, the first place, meaning that the price is being rising higher, or that there is no stock available in order for them to exit. We can see here clearly that the price is not higher, the price is going down. At its height, it was worth $72. Currently it's worth $11. So currently the price is going down. And the other thing is, it's available not only because we can see that the demand for the stock has gone down, people are not demanding the stock as much, but also we can see that the price is $11, and any one of us can now go and buy AMC stock for $11, right? The market price is what you can buy it for. It's not what somebody wants to sell it for. It's not what somebody believes it is. It's how much you can actually go out and buy it for. That's what the market means. The market is what you can get something for, what the price you will pay for something for, right? The short squeeze in AMC took place all the way up until price started releasing from its height. So again, I hope that was clear. Is everybody clear on that? I just want to make sure the chat is clear on, today we covered what shorting is and what creates a short squeeze and how the short squeeze comes about, right? So Celia says one, so we're clear about the short squeeze. I know Neil says yes as well. I know it's hard for a lot of people to hear this, and I understand that, right? But as I said, it's time for us to, as I said, when we're talking about, as I said at the beginning of the show, when we're talking about a bull market and investing in the bull market, investing in bull markets is a lot easier to make money than it is in bear markets, right? So, we have to really get focused on our financial education and be savvy when it comes to, investing into assets and making investments, right? Because, we're getting to the point where, as we saw during the week, a lot of people got hit heavy by this, dip in cryptocurrency. And, we're about to go through a whole season of, a bear market happening. And the bear market is going to separate those who are, up on their financial knowledge, those who are up on their financial education, And if you're not on your financial education, you're going to get wiped out, right? So this is why we're here at Focus on Investing, to teach people, the ins and outs of trading strategy. I want you to understand clearly what the trading strategy is, so that, once this whole season comes in and everybody gets wiped out, again, as I said, survival of the fittest is about being adaptable, and then being able to, be versatile, and being able to move between markets and understand, reading these charts. It's the intelligence and understanding, what things are and how to understand and read the charts that allows you to survive in these trying times that is going to be coming up. All right, so we've gone well over our 2-hour allotted time slot, but I hope everybody has found this information useful. And again, apologies for, I know a lot of people have been excited by the AMC play, but again, this is why I keep saying why I personally am not involved in the AMC play, because of, the setup doesn't work for me, right? Even though it's a fundamental play and I'm a technical analyst, I understand the fundamentals that go into setting up a short squeeze play, right? And if those fundamentals are not there, I prefer to tell you the bad news, and have you educated rather than you get caught out, right? Us at the Focus on Investing community, we have to be having our wits with us, and understanding that even if you choose to invest, now I'm not telling you not to invest in this. If you want to invest in this, you can invest in it, but understand what you're investing in and why you're investing in it, right? Everybody has the ability to invest in whatever they want to. It's not for me to tell you what you invest in and what you don't invest in. My aim here at Focus on Investing is about giving you the technical analysis so you can understand charts and read charts and make the decision for yourself and invest. And again, if you want to invest in something, understand why you're investing in it. Don't invest in this and say you're invested in a short squeeze and there is no short squeeze here. The setup for the short squeeze does not exist, right? So just understand. Now, you can still invest in it and it not be a short squeeze, but understand you're not investing in a short squeeze play. You're just investing in it like any other stock. And then the question would be, if you're investing in this like any other stock because you're not investing in a short squeeze, why would you then invest in a stock that is going down? And even if, people say that this stock can possibly turn around in the future, it possibly could, but it also possibly couldn't, or it possibly could keep going sideways. The time you're sitting here umming and ahhing, thinking, is this stock going to go up or not? There are stocks right now that are going up. You could be sitting here making money with your investment going up, rather than, sitting here on a stock that's going down or investment that's going down, or hoping and praying that it might go up. Whether or not it's being manipulated or not, the fact that it could possibly be manipulated, will go to show you that it is possible that these people could cheat you out of your money, right? It could be to the fact that they remember what they did with Robin Hood. They also did that with Palladium, right? And Russia. Well, no, not Palladium. Sorry, nickel. Right. Remember when the nickel price got too high, they shut down the market. Remember when when people were buying too much AMC, they shut down the market. Right. So don't think that the other forces that work in the markets can't manipulate the markets and can't cheat you out of your position. Right. So it's a very precarious position to be basing your financial future and relying on what they might or might not do, right? And relying on news that you can't necessarily prove. Is it possible that it's worth more and it's being manipulated? Possibly, but can you directly prove that, right? You have to substantiate what you're saying. And, this is why I like technical analysis, because technical analysis is substantiated by facts and what you can tangibly prove, right? I can substantiate the fact that AMC stock is worth $11 because I can pull it up on the chart and I can also go and buy it. you know, that is confirmation for me that it is worth that price, right? So my aim here at Focus on Investing is to get you into the mindset of technical analysis where you can prove and substantiate, you know, your investment strategy. And when you're putting your money behind something, you can have, you know, a tangible reason, an example as to why you're put your money behind something. You know, I spoke about this before. You know, whenever you're investing in something, you should be able to explain and break down exactly why you picked this particular stock. Also, you know, you can also go back years later and look at a chart of a certain stock and tell yourself exactly why you invested into that particular stock. We have a comment from Celia, says that technical analysis speaks for itself. The market shows its hands with technical analysis. And this is exactly what I'm talking about. You know, this is why I like technical analysis over fundamental analysis. Fundamental analysis is a lot of time based on news, noise, and opinions and hearsay rather than something you can tangibly prove, right? So again, this is what we do here at Focus on Investing. We teach you how to do this. And, you know a lot of people that lost a lot of money, you know, during this past week due to, you know, not having correct investment strategies. And I want to make sure that I teach you guys, you know, how to invest properly and understanding exactly what you're doing with this financial investing, so you guys do not get caught slipping, you know, guys do not get caught out. And, you know, and again, it's a serious time that we're in, you know. It's, you know, those who are really serious about changing their financial future and their financial destiny are taking it serious and are really focusing on, you know, focusing on putting on that time and that effort in order to learn these strategies and lock into getting their trading strategies to correct. So again, if you guys want to learn more and learn a fundamental trading strategy, you can go to focusoninvesting.io, right? And I want to see you guys winning, man. I want to see you guys, you know, riding this storm. I don't want to see you guys wiped out. You know how many percent of traders end up blowing their account? I think it's like 95% of traders end up blowing their account. Why? Because they don't have, you know, the proper and you know, the proper skill set in order to properly, you know, substantiate their trading account. We're seeing that happening now, right? When the market is turning around, a lot of people are getting caught out with this market situation, right? So again, if you guys want to learn, you know, the ins and outs of how to do trading and learn all the key strategies, not only, you know, the proper trading strategy, but also proper risk management, how to multiply your winnings, and also get the ability to get access to all of our key indicators and tools and our setups, go to focusoninvesting.io. Again, if you would like to support the stream and if you thought the stream was informative, you know, again, invest in the stream, right? You if you enjoy this this information and you want to see me keep doing this information and you find it informative, then again, you know, the Cash App is on the screen, # focus on investing. And yeah, I appreciate you guys for joining me. We'll be here again same time next week, 8 p.m. GMT, 3 p.m. Eastern time, and 12 p.m. Pacific time. Again, we're here for any kind of questions and comments you want to do. Anything along trading, if anything you particularly want me to cover, you can leave comments and let me know, and then we can kind of delve deeper into that. All right, everybody, I hope you guys have a blessed week and take care. Peace.